Now in just a moment we're going to be speaking with Milton Hunter. He spent nearly 3 decades as a financial analyst and investment banker with a focus on precious metals since 1992. And I wanted to read you really quickly a recommendation that I have from one of Milton's clients. Milton has the unique ability to understand the systemic drivers, trends, and implications of the market forces at both the 30,000-foot view and the up-close view. Now, I appreciate his gift of teaching and simplifying complex concepts. He stresses market intelligence and shares an uncounted amount of information through his daily market reports. He's well known for conducting himself with the highest level of professionalism, honesty, and integrity. And I can tell you, I've personally seen Milton get too much gold out of an order and actually return some of it. So we're about to be speaking with someone that's on the level when it comes to precious metals. How are you doing today, Milton?
Good, thank you.
All right, so we're going to get a big general overview of the economy, where it's going, the dollar, and I wanted to start by asking you, why should people protect their savings with precious metals?
Well, let's start with first a historical look at the last 13 and a half years, the dawn of the new century, as it were. The dollar, compared to gold and silver, our tangible monetary assets, has lost over that 13 and a half year period 360% against gold and 306% against silver. So the idea of saving through precious metals is to take advantage of the hedge against inflation or price erosion by money printing, etc.
Right. So for people that don't know, what is quantitative easing, and what's the effect on the dollar of quantitative easing going forward?
Well, QE, basically, from Wikipedia, is the unconventional monetary policy used by central banks to stimulate the economy when standard monetary policies have become ineffective. So it started on the heels of the financial crisis in 2007. Last year, 2013, the Fed pumped out, on average, $92 billion a month, which was approximately split 50-50 to try to reinvigorate the housing market and, of course, the bond market. So QE policy kicks the can down the road to a large extent. And, of course, on the chart, we can show basically that through the expansion of the debt for our country, it has exploded over that 10-year period. And as well, we have now gotten to a 100% debt-to-income ratio, which is on the heels of what Japan is basically doing as a model. So it's affecting the Western banking model as a whole.
Now, when we're looking at the economy and the dollar having such an issue, I think it's appropriate to talk about the bail-in situation. So what exactly, for people that don't know, what is a bail-in, and how could that happen in the U.S.?
Well, a bail-in is somewhat the opposite of a bailout, meaning on a bailout, the taxpayer is responsible for rescuing the failing entity, be it the banking sector, etc. The bail-in is a new concept of basically being able to go in and attach money under certain circumstances from shareholder, bondholders, and even depositors, where we are considered with our money in the bank as an unsecured creditor. Now, to give you an idea how this has grown from Cyprus, and I want to spend a minute on this because I think it's very important for people to understand. The Cyprus investors were subjected to a 47.5% loss of their savings over 100,000 euros. Capital controls were put in place over a weekend, which was called Resolution Weekend. That actually was a 2-week period where banks were closed. And this is the first time in history that capital controls have ever been imposed within the Eurozone. Now, those controls included limits on bank withdrawals, foreign money transfers, and credit card transactions. Some of these limits have already been adopted in the United States banks, just to let you know, Andrew. As an example, in Cyprus, you could only withdraw 300 euros a day from an ATM branch. You could only carry 3,000 euro traveling out of the country. And the lesson learned from that is there is no notice. So they will not allow you to go in there and get your money out of the bank before they're going to bail in. Poland, Iceland, Europe, Italy, New Zealand, Canada all have adopted one form or another of this concept moving forward. And of course, it's very concerning for people that are storing money in the bank, considering it safe from attachment.
Yeah, the amazing thing to me when I hear about the bail-in, and he's talking about creditors of the bank. You are a creditor of the bank. If you have your money in the bank, you are now, under the law, going to be a creditor of the bank. So if there's any situation where they feel they need more capital and there's no bailout, it's now the bail-in, where they will take your money out of the bank. Just a crazy crazy situation.
Well, potentially under circumstances, they may consider too big to fail banks more important than the depositors' monies over a certain limit. So it could be an FDIC insurance limit for us. In some of these countries, they were reducing the limits that they would guarantee against any form of attachment or garnishment. In the case of Poland, with their pensioners, they lost 50% of the pension benefits, all of the government pensioners for the state of, from the country of Poland, excuse me. So it's a scary new concept that is spreading like wildfire across the countries.
So with this economic situation going on, I think we can understand what the situation is and maybe why people are buying so much gold in China. So I wanted to ask you, how much gold are the Chinese actually buying? Are they just swimming in it like Scrooge McDuck? So in terms of like the real number, how much gold exactly really is China acquiring? Have they bought everything?
Well, they're buying everything that's coming out of the ground and then some, to answer the question. But let's first look at some numbers and a cute little cartoon, a little sad as far as what it represents, but what you'll see is China on one side, the U.S. on the other, a fence in the middle. We have the U.S. throwing gold bars across the fence, and we have the Chinese throwing our U.S. dollars back at us across the fence. So, again, cute little cartoon, I thought, to bring a little levity to the conversation. Back to last year, 2013, U.S. gold exports. From January through October 31st, we basically shipped out, this chart, of course, doesn't say where it went, but we assume much of it, if not all of it, went to the east. 623 metric tons of gold. So China, who has stopped exporting any gold, is importing all that is coming out of new ground production. That's their model, and much of the East is taking this massive spike of buying gold. We basically siphoned off 623 metric tons of gold from our country to points unknown last year through October. And with the November, December numbers, who knows what the total ended up. The chart underneath will show you, really, I think, better than words, exactly from around mid-2011 forward, how Chinese imports have spiked to unfathomable numbers. You'll see their activity from 2001 all the way up through about mid-2011 was quite tame relative to what's happened since. So we believe that they are in this massive acquisition stage to support their currency with gold, and of course look to make a play for the next global reserve status.
Yeah, so get ready to be going to McDonald's. You want your Happy Meal and you're paying with yen.
Oh, I wouldn't go that far, but what this could mean is that you're paying twice as much as what you would pay today if the dollar collapses from the 80 level that it is currently holding down to the 40. That means that everything you're going to buy just doubled in price.
Right. Good deal. Now, with the value of the dollar, where has that gone in the last 10 years, or even since the dollar is being tied to the Federal Reserve?
Well, looking at a chart here, and I wanted to use several currencies to show that we're all in the same boat somewhat together. From the year 2000 through 2013, end of 2013, this chart will show in the blue line the U.S. dollar, in the red line the Canadian dollar, in the black line the euro, and in the green line the British pound sterling. All have dropped precariously in their purchasing power over that 13-year window, with the U.S. dollar and the pound almost identically tracking from 2010 forward into the worst of the four. Looking also at a longer period of time, which would be the 100-year contract that the government had with the Federal Reserve, and this chart shows very clearly that the U.S. dollar now has only retained 5 cents of its original $1 of purchasing power over the 100-year period. That's a failing policy.
That's a good deal. 5 cents out of every dollar you get to keep.
This is what a failing monetary policy looks like.
So what we see now is a lot of trading on the paper market of gold and silver in the U.S. We see a lot of commodities being shifted around in gold and silver. We see a lot of ETF action with gold and silver in the U.S. But how is the physical gold and silver market different than the paper market for precious metals?
Well, Andrew, one is a hard, tangible asset that has intrinsic value, and one is not. Many of these derivatives, which is what you were referring to, be it a future contract an option contract, an ETF, even a mutual fund trickle down. They aren't attachable with anything real at the end of it. In other words, if you own an ETF share, you own an iShare, if we're talking about the two largest ones in the country. You cannot, unless you're George Soros or someone of his ilk, say, I want to turn in my iShares for bullion back. It just doesn't work that way. So if they're leveraged, there's a bullion there. There's a lot of discrepancies about the validity of these type of vehicles. They're not audited. We believe they're highly leveraged, and we believe that many investors, if they're doing this to preserve purchasing power and to hedge against inflation, are in the wrong vehicle. You only are going to get that through the acquisition of the real hard asset, which is, coins and bars of a gold, silver, platinum, or palladium for that matter.
Now, for those who don't know, what is the COMEX, and how huge were the withdrawals of physical gold and silver made in the last year?
The COMEX is owned by the Chicago Mercantile Exchange, and its role is to basically warehouse the assets that they issue the future contracts against. In a perfect world, it'd be a 1-to-1 ratio. If they're going to issue 1 million shares of paper gold, they have 1 million shares sitting in the vault against it. But that is obviously not the case in the real world. Last year, withdrawals from the COMEX of their deliverable gold bullion inventory plunged by 78%, and it was leveraged 69 times over in the paper IOUs that they issued against their deliverable registered inventory. And if you think that number is out of whack, they were 1,800 times leveraged their silver paper issues against their deliverable inventory. So at some point, obviously, it's got to run off the rails should the investors or speculators stand for delivery. And that's, of course, a major concern right now of default with the COMEX.
Now, with a short supply of physical gold and silver in the U.S., way beyond what we thought might actually be there. I mean, who knows if there's even any gold in Fort Knox, right? What would happen if China started selling their stockpile of U.S. treasuries? What would happen to the dollar?
Well, in the simple answer, it would crash. Right now you have, and I saw this in one of our marketing reports that we provide for our clients daily, that between Russia and China, they own 30% of our debt obligations. So Russia had recently, made a veiled threat that they would start dumping dollars if, certain actions were taken against them. So it's a concern that at one point when they have achieved their goal, they have enough gold, they have it to back the currency. Russia and China are part of several nations that have joined together to form a new central banking model. That will be hard asset backed, be it with gold and other assets, but gold will be the linchpin as far as for backing trade settlements. When they have enough, if it doesn't hurt them too much, certainly it would be to their benefit to dump dollars and create more of a slide than we've already seen in the purchasing power lost of the dollar, which has been 95% over the last 100 years. So it's a scary figure.
Now, I wanted to ask you also about public debt and where we are as a country. How much public debt are we really facing?
Well, according to these charts that I had pulled up in preparing for our meeting, from 1965 all the way basically through the 90s, we had a very slow and gradual uptick to government debt, where it basically stayed around between 0 and 4 million. Of course, that has exponentially grown up, and looking at the last 10 years, it has shot up now to, as we know, $17 trillion of debt. What that means also is that the percentage of debt to GDP, which is income, has now for the United States reached 100%. So we owe as much as we bring in, which of course is an unsustainable model.
No, I mean it makes sense. If you make $60,000, you should also owe $60,000 to somebody. I mean, that's just the model for a great functioning economy.
It's where we are today.
So speaking about the physical store of gold, I know there used to be a lot of gold in the COMEX. Is there any gold in the COMEX? What's the COMEX doing?
Well, the purpose of the COMEX, which is owned by the Chicago Mercantile Exchange, is to hold a registered inventory to back the paper it issues through future contracts. In a perfect world, it would be the 1-to-1 balance, but of course in the real world that's not how it works. Looking at the chart, and I think the thing that's most interesting about this, which is a chart going back to 2009 through the end of last year, the huge drop in the COMEX inventory dovetails exactly with the request from Germany for its gold back that was given to the Fed in New York to hold for safekeeping some 50 years ago. And for whatever reason, when that was announced, the COMEX dropped inventories and basically shed 78% of its registered inventory last year alone. The chart underneath will show where the flow of gold bullion last year came from, where you'll see it absolutely hemorrhaged from the GLD, which is the America's largest gold ETF holding. I mean, it lost over 500 metric tons of gold, and of course the COMEX was at about 100 metric ton loss of gold. So where this gold is going is the question we would like to know, but of course they don't have records for all of that.
And for Germany, if you're waiting on your gold back, you know, it might be coming in baseball trading cards.
Well, interestingly enough, there was a junior position, speaking of Germany's gold, held by another country that took weeks to return. And of course, the best deal that they could get from the New York Fed was that it would take a 7-year window to return its gold, of which they were woefully short in year one last year, only returning 5 metric tons of over 350 that's due.
Yeah, so...
And none of those were the original Brunson Bank bars that went in, coincidentally enough.
I wonder which bank in China has all of Germany's gold.
We would probably never know. I would assume they've been resmelted with new serial numbers to break the chain of ownership.
Right.
That's my assumption.
Now, I wanted to ask you, because what we're talking about is the dollar, but what relation does that have to the stock market? Is the stock market still a safe haven for savings in comparison to precious metals or anything else?
Well, Andrew, I don't believe the stock market has ever been considered a safe haven of any sort under any period. It's a speculator's market where you're looking to potentially have a profit above your investment. But we've seen many over history stock market corrections and crashes. I think we're on the heels of one right now. If you technically look at the values and the PE ratios, the stock market has been buoyed and somewhat intentionally by QE that we discussed a moment ago in this easy hot money flow, and also by holding interest rates down too low too long, which has forced many people, specifically the retired age group, into equities that have no business being there. They don't understand it, and they're desperate for a yield anywhere they can try to find it. And of course, this is uneducated investors in a high-risk area. So, no, I wouldn't consider the stock market ever as a safe haven by nature. And you have to consider the tide with the dollar, which I believe was the first part of your question. As the dollar is eroding in purchasing power, any investment, and I think this is very important for everyone to understand, that's tied in settlement to the dollar, a stock, a bond, a mutual fund, whatnot, you're losing purchasing power by the vehicle that you're in.
Right.
So it's not so much if I had a 20% return in equities last year, was that a gross or net return when you look at the falling erosion of the dollar, in large part by this excessive and massive money printing campaign that's gone on over the last several years.
Now, I know we've talked a lot about gold, so I just wanted to take a quick comparison between gold and silver. What do you see doing better in the future, if either?
Looking at previous bull markets and looking at the bull market that we've been in since the turn of the century, statistically, silver as a percentage has outperformed gold than it did in the bull market back in the 80s. Part of this is simple math because we're talking about commodities that have a 64% price ratio against each other. So, $1 up in silver is not like $1 up in the gold market because of the price differences. Part of what we do at our firm is to, on a one-on-one basis with potential clients, analyze their risks, their time frames, their objectives, and then try to structure, be it through an IRA or through a cash deposit, or we're vaulting for them or delivering to them, or any combination of all of that, a prudent measure, because this should represent your core savings and your core holdings. This is not an investment. You're basically shifting from paper money to hard asset money that historically has held up much better during times of political uncertainty and unrest, certainly all of which we have available and present now. So basically, the idea of going into precious metals is to preserve future purchasing power and to retain the intrinsic value that it has.
And I know that the Bullion Advisory Group is also capable of helping people into platinum and palladium, and I just wanted to know, how do you advise people as the differences between gold and silver and platinum and palladium?
Well, we monitor all of the technicals of the markets to see basically where the hot action is. Gold and silver, the two monetary metals, are what people refer to and think about. Where if I was to probably go on the street and ask 10 strangers what is platinum and palladium and what is it used for, I'd probably get maybe one correct answer. So
it's for records. It's for record sales. When you sell records, you get platinum.
They lack the cachet and the knowledge because they haven't been used as money for thousands of years if that's gold and silver. But they all have different market drivers. They have different times to be in them. Platinum and palladium are really industrial metals. They are precious. They are very dear. But they're used primarily in the automobile industry, and that's the main driver, where silver has 10,000 applications and is used in virtually everything. We usually like to take the path of least risk in recommending, once we've gained an understanding of what our clients' objectives are. So our book of business is more heavily weighted in the gold and silver sector than in the platinum and palladium for the time being.
And for anybody that's a first-time buyer of precious metals, is there a difference in premiums? Is there a difference in buying gold, silver, platinum, and palladium for people that just they've never done this before?
Well, that's a starting point because the media is going to drive you towards the most expensive markup item through the retail market. So collectible coins is usually even done as a bait and switch from the advertising where they're referring to bullion prices, and then once they get you on the phone or in their office or in their clutches, so to speak, the bait and switch sometimes happens with some of the less reputable dealers. But you have to understand their premium or markup, which is the same term, refers to how you're buying the product and what the product is. A numismatic coin or a collectible coin is going to carry the highest premium for the alleged collectability factor, which is never guaranteed when you go to sell. Followed by government minted products, and you have private minted products. Then you have, of course, all of the series of the bullion bars or ingots, and the bigger you buy, the less the premium is per ounce. So it's a rather complicated formula as to where to get the best value, and that's part of what we put together with our prospective clients, especially for our vaulting services, because for home delivery you need, even at a higher premium, smaller denominational items used potentially for barter, where if it's going to be vaulted for you, get the big bars, though they're impractical to work with. It's going to give you the very best value. You'll end up with more ounces, which is at the end of the game what we're all about.
And finally, I wanted to ask you and give you the chance to explain for people what's the biggest benefit that they would have with working with you and the Bullion Advisory Group, rather than just buying gold and silver from a retail place. What's the benefit that they would get for actually working with you specifically?
Well, our firm specializes in a strong backbone of education. From the first day of the relationship through the life of the relationship. We provide reports on a daily basis so we can keep our pulse on the markets, especially the last couple of years when there's been a lot of activity that may be considered negative. You have to understand really what's behind this activity, and it makes it a little bit easier to hold through those periods. We have, as a broker-dealer, access to risk management models and time frames of when to buy and sell that individuals simply on their own in the retail world do not. So we have a reach in the global market. We can buy and sell when you're sound asleep in the middle of your bed at night, should we need to, either to reduce risk of getting out of a downtrend or to buy during an hour where we had a dip that we would not have in the normal U.S. market hours. So it's our reach and our services driven through our market intelligence.
Well, thank you very much, Milton Hunter. It's been an absolute pleasure.
Pleasure is mine. Thank you, Andrew.